There's a market worth $600 trillion that almost nobody understands, one that nearly destroyed the global economy in 2008, and it's now 10 times bigger than it was then. Warren Buffett called derivatives financial weapons of mass destruction in 2003. He was right. They triggered the collapse of Lehman Brothers, the bailout of AIG, and the near destruction of the entire banking system. The response to that crisis wasn't to eliminate derivatives or even reduce them. It was to make them bigger. Today, the derivatives market is worth more than 6 times the entire global economy. When it explodes, and it will explode, there won't be enough money in the world to bail it out. Most people have never heard of derivatives. Even many professional investors struggle to explain them. But these complex financial instruments underpin every major bank, every pension fund, every insurance company, and every government bond market on Earth. They're supposed to reduce risk by allowing institutions to hedge against losses. In reality, they multiply risk by creating leverage on leverage on leverage. Bets stacked on top of bets, until nobody actually knows who owes what to whom. And that's when the system collapses. In 2008, it required $29 trillion in global bailouts and guarantees to prevent total financial meltdown. The derivatives market then was about $60 trillion. Today, it's $600 trillion. When this bomb explodes, the blast radius will be global, immediate, and unstoppable. Let me show you why the next financial crisis won't be like 2008. It will be worse, much worse. To understand why derivatives are so dangerous, start with what they actually are. A derivative is a financial contract whose value is derived from an underlying asset. That sounds simple until you realize the underlying asset can be anything: a stock, a bond, a commodity, an interest rate, a currency exchange rate, even the weather, or the likelihood of a company defaulting on its debt. The derivative doesn't require you to own the underlying asset. You're just betting on which direction it will move. It's like buying insurance on your neighbor's house burning down. You don't own the house. You just collect if it burns. That's a derivative. The most common types are futures, options, swaps, and forwards. A futures contract lets you bet on the price of oil, gold, or wheat at a future date without actually buying barrels of oil or bushels of wheat. An option gives you the right, but not the obligation, to buy or sell an asset at a specific price. A swap is an agreement to exchange cash flows, like trading a fixed interest rate payment for a variable one. And forwards are customized contracts between two parties to buy or sell an asset at a future date for a predetermined price. Each of these can be useful for legitimate hedging. A farmer might use a futures contract to lock in the price of wheat before harvest, protecting against a price drop. An airline might use derivatives to hedge against rising oil prices. A corporation with debt in multiple currencies might use swaps to manage exchange rate risk. But the derivative market isn't dominated by farmers hedging wheat prices. It's dominated by banks making leveraged bets on interest rates, credit risk, and currency movements with borrowed money. And here's where it gets dangerous. The notional value of a derivative is the face value of the underlying asset, but the actual money at risk is usually much smaller. If a bank enters a $100 million interest rate swap, the notional value is $100 million, but the bank might only put up $1 million in collateral. That's 100-to-1 leverage. If the bet moves 1% against the bank, the collateral is wiped out. If it moves 2%, the bank owes money it doesn't have. Multiply that by thousands of contracts across dozens of banks, and you have a system where a small market movement can trigger cascading failures. The real problem is complexity. Modern derivatives are so complicated that even the people who create them can't fully predict how they'll behave under stress. Credit default swaps, one of the derivatives that destroyed the system in 2008, were supposed to provide insurance against bond defaults. In practice, they became side bets, where investors who didn't even own bonds could gamble on whether those bonds would fail. AIG, the insurance giant, sold hundreds of billions of dollars worth of credit default swaps without setting aside enough capital to pay out if mortgages defaulted. When the housing market crashed, AIG owed more money than it had. The U.S. government had to inject $180 billion to prevent AIG from collapsing and taking every major bank with it. But here's what makes derivatives truly terrifying. They create counterparty risk that spreads like a virus. If Bank A owes Bank B money on a derivative contract, and Bank A fails, Bank B doesn't get paid. Now Bank B can't pay Bank C, and Bank C can't pay Bank D. The failure of one institution cascades through the entire network in hours. That's what happened in 2008 when Lehman Brothers collapsed. Lehman had over $35 trillion in derivative contracts when it went bankrupt. Every institution that had traded with Lehman suddenly faced losses they hadn't anticipated. Some of those institutions couldn't absorb the losses and needed bailouts. Others survived but stopped trading with anyone they didn't absolutely trust, freezing the credit markets and turning a financial crisis into a global recession. The lesson from 2008 should have been to ban or severely limit derivatives, especially the most dangerous types, like naked credit default swaps where you're betting on defaults of bonds you don't even own. Instead, the Dodd-Frank Act created some reporting requirements and moved some derivatives to central clearinghouses. But it didn't reduce the total size of the market. Banks argued that derivatives were essential for managing risk, that they provided liquidity, and that eliminating them would harm the economy. Regulators believed them or were too captured by industry lobbying to act. The result is that the derivatives market didn't shrink after 2008. It grew massively, from $60 trillion to over $600 trillion today. To understand why $600 trillion in derivatives is a civilizational threat, you need to understand what happened in 2008 when the market was only $60 trillion. The crisis didn't start with derivatives. It started with subprime mortgages, loans to people who couldn't afford them, bundled into mortgage-backed securities and sold to investors. But derivatives are what turned a housing bubble into a global catastrophe. Banks didn't just hold mortgages. They created complex derivatives based on those mortgages, amplifying both the profits on the way up and the losses on the way down. Lehman Brothers was the fourth largest investment bank in America when it collapsed in September 2008. On its balance sheet, Lehman reported assets of $639 billion against liabilities of $613 billion, making it appear solvent. But buried in footnotes was the real danger. Lehman had over $35 trillion notional derivative exposure. These weren't assets Lehman owned. They were bets Lehman had made with counterparties around the world. Most were interest rate swaps and credit derivatives tied to the mortgage market. When housing prices started falling in 2007, those derivatives started losing value. Lehman's counterparties demanded more collateral. Lehman couldn't provide it. By September 2008, nobody would trade with Lehman because everyone assumed the bank was insolvent. The failure itself was catastrophic, but the cascade was worse. Lehman's bankruptcy meant that every derivative contract it had entered was now in default. Institutions that thought they were hedged against risk suddenly weren't. A European bank that had bought credit protection from Lehman found itself exposed to billions in mortgage losses with no hedge. A pension fund that had entered an interest rate swap with Lehman couldn't collect the payments it was owed. The interconnectedness meant that Lehman's failure instantly created losses at hundreds of other institutions. Some of those institutions failed. Others survived but stopped trusting anyone else, freezing the credit markets. AIG's collapse was even more revealing because it showed how a single type of derivative, credit default swaps, could destroy a company with $1 trillion in assets. AIG's financial products division had sold about $500 billion worth of credit default swaps to banks and investors, essentially insuring them against losses on mortgage-backed securities. AIG collected premiums and assumed the risk was minimal because housing prices had never fallen nationwide before. When they did fall, AIG owed tens of billions of dollars it didn't have. The company's credit rating was downgraded, triggering clauses in the derivatives that required AIG to post additional collateral immediately. AIG couldn't come up with the cash. The Federal Reserve stepped in with an $85 billion emergency loan in September 2008. That wasn't enough. By March 2009, AIG had received $180 billion in government support, the largest bailout in history. But the AIG bailout wasn't really a bailout of AIG. It was a backdoor bailout of every major bank that had bought credit default swaps from AIG. Goldman Sachs received $12.9 billion. Merrill Lynch received $6.8 billion. Bank of America, Deutsche Bank, and dozens of others received billions each. The government funneled money through AIG to ensure those banks didn't suffer losses on the derivatives they had purchased. This revealed a dark truth about derivatives. When they fail, the losses don't disappear. They get transferred to taxpayers through bailouts. The banks that created the risk get rescued because allowing them to collapse would bring down the entire financial system. The total cost of saving the financial system in 2008 was staggering. The U.S. government committed $700 billion through TARP, the Troubled Asset Relief Program. The Federal Reserve created $4 trillion through quantitative easing. Global governments and central banks provided another $25 trillion in loans, guarantees, and bailouts. In total, the commitment reached approximately $29 trillion, nearly twice the size of the U.S. economy at the time. All of this was done to prevent a complete collapse of a derivatives market worth $60 trillion in notional value. The system survived, but barely, and the critical lesson went unlearned. Derivatives had become too large and too complex for anyone to control. The Dodd-Frank Act, passed in 2010, was meant to reform the derivatives market. It required some standardized derivatives to be traded through central clearinghouses, which would theoretically reduce counterparty risk by having a central entity guarantee both sides of each trade. It also required more reporting so regulators could see who held what. But it did not limit the size of the market. It did not ban the most dangerous derivatives, and it did not address the fundamental issue that banks continued using extreme leverage to make massive bets with depositor money and taxpayer backing. Within a few years, lobbying weakened even the modest reforms that were implemented. The derivatives market resumed expanding. By 2015, it exceeded $600 trillion. The derivatives market in 2008 was about $60 trillion in notional value. Today, it exceeds $600 trillion, 10 times larger than the market that nearly destroyed the global economy. For perspective, global GDP is approximately $100 trillion. The derivatives market is 6 times the size of the entire world economy. If even 5% of those derivatives fail, that amounts to $30 trillion in losses, 3 times the total cost of the 2008 bailouts. There is no mechanism, no amount of money, and no policy tool capable of absorbing losses of that magnitude without collapsing the global financial system. The composition of the derivatives market makes it even more dangerous. The largest category is interest rate derivatives, which account for over $500 trillion of the total. These are bets on the direction and volatility of interest rates. Banks use them to hedge exposure, but they also speculate with them. When interest rates are stable, these products appear safe. But when rates move quickly, as they have over the last 3 years, the risk explodes. The Federal Reserve raised interest rates from near zero in 2021 to over 5% by 2023. the fastest hiking cycle in 40 years. Every increase created winners and losers in the derivatives market. The losers accumulated losses that now sit on bank balance sheets, hidden by accounting rules that allow institutions to avoid marking these positions to market. The second largest category is credit derivatives, totaling about $50 trillion in notional value. These include credit default swaps, the same instruments that destroyed AIG. Regulators promised to clean up this market after 2008, but they failed. Banks and hedge funds still use credit default swaps to bet on corporate and sovereign defaults. The difference now is that corporate debt has exploded since 2018, growing from $2 trillion to over $10 trillion in the US alone. Much of that debt was issued when interest rates were low. As companies refinance at higher rates, some will default. When they do, the credit default swaps written on their debt will trigger payouts. If enough companies default at the same time, the institutions that sold credit protection will suffer losses they cannot absorb. That is the AIG scenario repeating itself, except this time there may not be a Federal Reserve willing to print another $180 billion to rescue derivatives traders. Currency derivatives represent another $100 trillion and are highly vulnerable to exchange rate shocks. The US dollar has been the world's reserve currency for 80 years, but its dominance is slipping. Countries like China, Russia, and India are increasingly trading in their own currencies. Saudi Arabia is accepting yuan for oil instead of dollars. If the dollar loses reserve currency status, or even weakens significantly, currency derivatives could experience violent swings. Banks that assumed long-term dollar stability may find themselves on the losing end of trillion-dollar bets. The unwinding would ripple across every market: stocks, bonds, commodities, and global trade. The most insidious aspect of modern derivatives is their complexity. After 2008, banks didn't simplify their derivative books. They made them more complicated by creating derivatives of derivatives. You can now buy options on credit default swaps or swaps based on indexes of other swaps. This layering creates exponential leverage, where even a small movement in the underlying asset triggers massive changes in the value of the derivative pyramid built on top of it. Nobody, not even the traders who design these products, can accurately model how they will behave under extreme stress. The mathematical models assume normal market conditions, continuous liquidity, and counterparties that always pay. In a crisis, none of those assumptions hold. Markets become illiquid, prices gap violently, and counterparties fail. That's when the models break and losses exceed anything risk managers predicted. The concentration of derivatives in a handful of institutions makes the situation even more fragile. In the US, 4 banks hold roughly 90% of all derivative exposure: JP Morgan Chase, Citibank, Bank of America, and Goldman Sachs. JP Morgan alone has over $54 trillion in notional derivative exposure, about 180 times its total capital. This concentration means that if even one of these institutions miscalculates, the entire system is in danger. There is no diversification. The biggest banks are making similar bets because they're all responding to the same incentives and market signals. When everyone is positioned the same way, a shock in one direction creates simultaneous losses across the system. That's not risk management. That's systemic fragility, disguised as sophistication. The derivatives market is not distributed across thousands of institutions. It is concentrated in 4 American banks that collectively hold more than $500 trillion in notional exposure. These are the same institutions that were bailed out in 2008, and today they are even larger and more leveraged. Understanding the scale of the risk requires looking beyond notional values to leverage ratios and interconnections. JP Morgan Chase is the largest holder of derivatives in the United States, with approximately $54 trillion in notional exposure. For comparison, JP Morgan's total assets are about $3.7 trillion, and its equity capital is roughly $300 billion. This means JP Morgan's derivative exposure is around 180 times its capital. The bank argues that the notional value exaggerates the risk because many derivatives are hedged, meaning positions offset each other. JP Morgan claims its net current credit exposure is only about $50 billion. This sounds comforting, until you remember that Lehman Brothers and AIG said the same thing before they collapsed. Their hedges worked until they failed. When counterparties default or markets freeze, hedges disappear, and gross exposure becomes all that matters. Citibank holds approximately $48 trillion in notional derivative exposure, against total assets of $2.4 trillion and capital of about $200 billion. Bank of America holds roughly $37 trillion in derivatives against $3.1 trillion in assets and $280 billion in capital. Goldman Sachs, though smaller, holds about $47 trillion in derivatives against total assets of $1.6 trillion and capital of $120 billion. Altogether, these four institutions carry around $186 trillion in derivative exposure, nearly double the size of the entire global economy. If any one of these banks makes a catastrophic error managing these positions, the losses could exceed their capital many times over, rendering them insolvent. The standard defense is that these institutions are highly sophisticated, with advanced risk models, teams of quantitative analysts, and regulatory oversight. But sophistication does not prevent disaster. It often enables it. Complex risk models create false confidence, encouraging institutions to take on positions far larger than they would with simpler, more cautious analysis. Long-term capital management, the hedge fund that collapsed in 1998, had 2 Nobel Prize winners on staff and used some of the most advanced mathematical models in finance. It still lost $4.6 billion in 4 months and required a $3.6 billion bailout organized by the Federal Reserve because its failure threatened the entire financial system. LTCM's derivative exposure was $1.25 trillion, a fraction of what the Big Four banks hold today. The interconnection between these banks creates a web where each one's survival depends on the other's remaining solvent. JP Morgan might hedge its interest rate exposure with Citibank. Citibank might hedge with Bank of America. Bank of America might hedge with Goldman Sachs. Goldman could hedge with JP Morgan. On paper, these positions appear offsetting, but in reality, they form a circular dependency. If one bank fails, the others face losses on their supposedly hedged positions. This was the dynamic in 2008 that turned Lehman's collapse into a systemic crisis. Every bank had exposure to every other bank through derivatives. When one fell, they all began to teeter. The central clearing requirement imposed after 2008 was meant to solve this by having a clearinghouse stand between buyers and sellers of derivatives, guaranteeing both sides of each trade. But clearing only covers standardized derivatives traded on exchanges. The vast majority of the $600 trillion market consists of over-the-counter derivatives, customized contracts negotiated directly between banks that are not centrally cleared. These bilateral contracts still carry the same counterparty risks that existed in 2008. If Bank A fails, Bank B suffers losses with no clearinghouse to make them whole. The reforms look effective on paper, but haven't fundamentally changed the structure of the market. Even cleared derivatives create systemic danger because the clearinghouses themselves have become too big to fail. If a major clearinghouse experiences losses that exceed its default fund, it could collapse, dragging all its members down. The largest clearinghouses have rules allowing them to tear up contracts or allocate losses to members during a crisis. In other words, If enough participants fail, the clearinghouse can effectively confiscate assets from surviving members to cover the losses. This means even banks that manage risk prudently could face massive unexpected losses if other banks at the same clearinghouse fail. This mutualizes risk in a way that discourages responsible behavior because careful banks end up subsidizing reckless ones. The derivatives market has survived for 15 years since 2008 without another catastrophic breakdown, creating the dangerous illusion that the reforms worked and risks are under control. But survival is not the same as stability. The market held together only because we experienced an unusually long era of low interest rates, low volatility, and constant central bank intervention whenever stress appeared. That era is ending. The triggers for the next derivatives crisis are already emerging, and several are likely to activate within the next 12 to 18 months. The most obvious trigger is interest rate volatility. More than 500 trillion in derivatives are tied to interest rates, and those rates have experienced the sharpest swings in 4 decades. From 2008 to 2021, interest rates remained near zero, creating a stable environment that allowed banks to take massive positions without fearing rate shocks. When the Federal Reserve began raising rates in 2022, from 0 to more than 5% in just 18 months, it created immediate strain. Banks holding long-duration, fixed-rate assets began losing money as short-term rates climbed. Some of this became visible during the failures of Silicon Valley Bank, Signature Bank, and First Republic in 2023. But most of the damage is hidden inside derivative positions that banks do not need to mark-to-market under current accounting rules. The risk becomes even greater if the Federal Reserve is forced to choose between fighting inflation and preventing recession. If inflation stays high and the Fed keeps rates elevated or raises them further, more institutions will face losses on interest rate derivatives. If recession strikes and the Fed aggressively cuts rates, other institutions will be on the losing side of those trades. Either scenario creates losses large enough to threaten solvency. And if the Fed flip-flops, raising and then cutting as economic data swings, the volatility alone could exceed what banks' risk models anticipated, triggering margin calls and forced liquidations. Commercial real estate defaults form the second major trigger. More than $2 trillion in commercial mortgages must be refinanced over the next 24 months. Just 24 months at interest rates triple what they were when the properties were first financed. Many owners will default because the properties cannot support the new debt. These defaults will activate credit derivatives, particularly credit default swaps on commercial mortgage-backed securities. Institutions that sold protection on these securities will owe payouts they never expected to make. The CMBS market is roughly $600 billion, large enough that a spike in defaults could trigger tens of billions in derivative claims. This alone won't crash the global system, but it is sufficient to weaken multiple regional banks and potentially trigger cascading failures. European banking stress forms a third trigger that is already showing cracks. Credit Suisse collapsed in March 2023 and was absorbed by UBS through a government-forced merger. Deutsche Bank experienced a spike in its credit default swaps during the same period as investors questioned its solvency. Both banks hold massive derivative exposures. Deutsche Bank alone carries more than $40 trillion in notional value. If a major European bank fails, it will trigger losses at American banks connected to it through derivatives. The network is global. A bank failure in Frankfurt directly affects JP Morgan's balance sheet in New York through the derivative links between them. Sovereign debt crises in major economies may be the most dangerous trigger of all because they combine credit risk, currency risk, and interest rate risk. Japan's government debt exceeds 260% of GDP, the highest among developed nations. It has kept interest rates near zero for decades, but inflation and global rate pressures are making this approach unsustainable. If Japan is forced to raise rates, or if investor confidence collapses, the yen could crash, and Japanese government bonds could default. The derivative exposure to Japanese bonds worldwide is enormous. A Japanese debt crisis would send shockwaves through every major global bank. China faces similar structural problems. Local government debt exceeds $13 trillion, much of it hidden in off-balance sheet entities. The Chinese real estate sector, about 30% of the entire economy, is collapsing. Major developers like Evergrande and Country Garden have defaulted on hundreds of billions in debt. As these losses spread, banks and insurers that sold credit derivatives on Chinese debt will face critical payouts. Western banks are exposed to Chinese institutions through derivatives, meaning a Chinese financial crisis would immediately affect both American and European banks. The final trigger is geopolitical instability. Any major conflict that disrupts global trade, energy supplies, or currency markets could detonate the derivatives market. A war between China and Taiwan would halt semiconductor production and cripple the global economy. An escalation of the war in Ukraine could trigger energy shocks that bankrupt European industries. A major Middle East conflict could drive oil to $200 per barrel, creating inflation that forces central banks into impossible policy choices. Each of these events would create violent market swings that destroy derivative positions built on assumptions of stability. And because derivatives amplify risk through leverage, small moves in the underlying markets create enormous losses. The most alarming aspect of the $600 trillion derivatives market is that, when it breaks, there is no bailout large enough to stop the collapse. In 2008, governments and central banks committed about $29 trillion to prevent disaster, roughly 40% of global GDP at the time. It required global coordination, massive money printing, and political decisions once considered unimaginable. It barely worked, and it resulted in a decade of weak growth, soaring government debt, and the political upheavals we still see today. Today, the derivatives market is $600 trillion in notional value. If just 10% of that goes bad, the losses would total $60 trillion, more than double what was needed to stop the 2008 crisis, and more than half of global GDP. Governments do not have $60 trillion. They are already overloaded with debt from COVID spending, previous bailouts, and demographic pressures. The United States owes $36 trillion. Europe is similarly over-leveraged. Japan is beyond rescue with debt at 260% of GDP. China's official debt appears lower, but its hidden liabilities are massive. None of these governments can borrow another $10 to $20 trillion to rescue derivative markets. Bond markets would collapse under the weight of new debt issuance. Central banks could theoretically print the money through quantitative easing, but the consequences would be severe. The Federal Reserve's balance sheet grew from $800 billion before 2008 to $9 trillion during COVID. That money printing directly fueled the inflation spike from 2021 to 2023, the worst in 40 years. If the Fed printed another $20 trillion to cover derivative losses, inflation would spiral out of control. The dollar would plunge, imports would become unaffordable, real wages would collapse, and social unrest would follow. Saving the financial system by printing money risks destroying the currency itself, and a currency crisis is worse than a financial crisis because it harms everyone, not just investors. The political will for another bailout also no longer exists. In 2008, the public was shocked but compliant. Governments warned that the banks had to be saved or the entire economy would collapse, and people reluctantly accepted it. That acceptance has vanished. The past 15 years showed that bailouts saved banks but did little for ordinary people. Wages stagnated. Housing became unaffordable. wealth inequality exploded. The next crisis will arrive at a time when trust in institutions is lower, political polarization is higher, and populist movements on both left and right are demanding that the rich pay for their own failures. If governments try to bail out banks again, they'll face resistance that could escalate to ungovernable unrest. The too-big-to-fail doctrine that justified the 2008 bailouts has transformed into too big to save. The banks are now larger, more leveraged, and more interconnected than they were in 2008. Their derivative books are 10 times bigger. Their balance sheets are more complex. Their global reach means a failure anywhere propagates everywhere. The resources available to save them, government borrowing capacity, central bank credibility, political will, are all diminished from 15 years ago. The system has grown beyond the ability of any institution or government to rescue it. There's also a mathematical problem with bailing out derivatives that didn't exist with traditional bank assets. When a bank holds bad mortgages, the government can buy them, take the loss, and eventually recover some value when the housing market stabilizes. It's expensive, but comprehensible. Derivatives aren't assets. They're contracts between parties. When a derivative fails, one side loses and the other side wins. If the government bails out the loser, it's transferring wealth to the winner for no productive purpose. There's no underlying asset to eventually recover value from. It's pure speculation. And bailing out speculators with taxpayer money makes no economic or political sense. Furthermore, the opacity of the derivatives market makes it impossible to even determine who should be bailed out. When Lehman failed, it took months to unwind the derivative book and figure out who owed what to whom. In a systemic crisis where multiple institutions fail simultaneously, the tangle of offsetting contracts, bilateral negotiations, and complex netting agreements would take years to sort out. By the time anyone figured out the true losses, the real economy would have been in depression for years. You can't bail out a system you can't even understand. The only rational policy response would be to let the losses fall where they may, allow insolvent institutions to fail, and deal with the economic consequences directly, rather than trying to prop up a system that has become fundamentally unsustainable. That would mean bank failures, pension fund losses, widespread unemployment, and a severe recession or depression lasting years. It would be catastrophic. But attempting to bail out $600 trillion in derivatives would be even worse, because it would add currency collapse and hyperinflation to the list of disasters while not actually solving the underlying problem. So here we are, sitting on top of a $600 trillion derivatives market that's 10 times larger than the one that nearly destroyed civilization in 2008, held primarily by 4 banks whose failure would end the modern financial system, facing multiple triggers that will likely activate over the next 12 to 18 months, with no ability to bail it out if it goes wrong. Warren Buffett called derivatives financial weapons of mass destruction in 2003, and he's been proven right over and over. The response hasn't been to disarm the weapons. It's been to build bigger ones. The crisis is coming. It might start with interest rate volatility as the Fed flip-flops between fighting inflation and preventing recession. It might start with commercial real estate defaults cascading through credit derivatives. It might start with a European bank failure, or a Japanese debt crisis, or a Chinese real estate collapse. The specific trigger almost doesn't matter, because the system is so fragile that any significant shock will blow it up. When one major bank can't meet its derivative obligations, the cascade begins. Counterparties discover their hedges don't work. Margin calls force more selling. Central clearinghouses face losses that threaten their solvency. Within hours or days, every major financial institution in the world is facing losses it can't absorb. The government will announce emergency measures, The Federal Reserve will create lending facilities. Central banks will coordinate. Politicians will make speeches about protecting the system. None of it will work because the problem is too large. You can't bail out losses that exceed half of global GDP. You can't print enough money without destroying the currency. You can't negotiate enough debt forgiveness to make insolvent banks solvent again. Mathematics simply doesn't work. What comes after the derivatives market explodes is unknowable because we've never seen a financial crisis on this scale. The Great Depression was devastating, but it unfolded over years, giving people time to adjust. A derivatives cascade would unfold in days or weeks, moving faster than policy responses could follow. Bank accounts would freeze as institutions went into receivership. Credit cards would stop working. Pension funds would show losses so large that retirement becomes impossible for millions. The economic disruption would create social chaos as supply chains broke and unemployment spiked to levels not seen since the 1930s. This isn't speculation or doom prophecy. This is pattern recognition and basic mathematics. A market that was $60 trillion destroyed the economy in 2008 despite massive bailouts. That market is now $600 trillion. And the bailout capacity is gone. The triggers are appearing now. The cascade is inevitable. The only questions are timing and magnitude. And the answer is likely sooner and larger than almost anyone expects. Because every time a financial weapon of mass destruction has been created, it is eventually detonated. Derivatives are no different.